This is a chart tracking the price of Netflix's standard ad-free plan over the last decade. In 2015, a subscription cost exactly $9.99 a month. By 2026, that exact same plan costs $19.99. That is a 100% inflation rate on a digital service. We see this trend happening across the industry. When we add other major platforms to the graph, the growth lines become even steeper. Disney Plus has spiked by 172% over its baseline, while audio platforms like Spotify are up 30%. A decade ago, streaming executives practically begged you to share your passwords with friends and family. They wanted their software on every screen possible to replace the bulky physical hardware sitting in your living room. We tend to view this recent wave of massive price hikes as a reaction to external inflation or rising production costs, but the financial data points to a deliberate, calculated strategy. The chaotic streaming wars we thought we were watching were actually a rigid three-step corporate playbook. It is a strategy specifically designed to slowly, methodically trap the consumer. Step 1 of this playbook is Phase 1, the land grab. During this era, tech companies operated under a growth at all costs mandate. They used billions of dollars in investor capital to artificially suppress their prices and kill off legacy media. Think back to those early delivery models. Receiving unlimited movies through the mail for a few dollars a month was a massive subsidy. Wall Street was effectively paying for your entertainment to starve out the competition. That predatory pricing successfully trained an entire generation to abandon traditional television. Millions of households permanently severed their cable connections because the streaming alternatives were simply too cheap to ignore. But you eventually run out of humans to subscribe. Once market saturation is reached in places like North America and Western Europe, incremental growth becomes mathematically impossible. The math confirms that the golden age of cheap streaming was purely a temporary bait tactic used to build a monopoly. It was never a sustainable business model. That brings us to Phase 2, the moat. To understand how platforms keep us locked in, we have to look at demand elasticity. In economics, this concept measures exactly how sensitive consumers are to a change in price. Netflix deliberately transitioned its product from a luxury entertainment add-on into indispensable default infrastructure. It became the utility you expect to work the moment you turn on the screen. They weaponized the psychology of habit. We use these apps for background noise while we fold laundry or to keep up with the cultural conversation at work. Once a service becomes deeply embedded in your daily routine, your sensitivity to its price drops. This creates the paradox of subscription fatigue. When households feel overwhelmed by monthly fees, they ruthlessly cancel their niche secondary services, yet they cling desperately to their primary platform. This scatterplot illustrates the result. Streaming companies possess granular algorithmic data, proving that user retention stays stable even as the price keeps ticking higher. Platforms raise prices because their internal data proves we lack the willpower to cancel. They are extracting more revenue through micro-calibrations, betting that our habit is stronger than our price sensitivity. Now we enter Phase 3, the squeeze. The corporate mandate shifts entirely away from chasing new subscribers toward margin optimization, extracting the maximum amount of revenue from every single user. The password-sharing crackdown is a calculated sequencing move. It forces free riders into paying accounts, building a monetizable cushion for the company before the next blanket price hike. This diagram shows the mechanics of that crackdown. By converting borrowed logins into paying accounts, platforms massively expanded their monetizable base without actually adding new households. To catch the people who finally decide the price is too high, platforms introduced ad-supported tiers. If you try to cancel, they offer a cheaper downgrade, ensuring you stay in their ecosystem. Between extra member fees, premium 4K upgrades, and unskippable ad tiers, they have built a multi-layered monetization trap that extracts cash from every possible demographic. Every frustrating new feature, from commercials interrupting a movie to IP address tracking blocking your login, is a perfectly engineered mechanism designed to squeeze a captive audience. When we zoom out to the macro media industry, the picture gets bleaker. Smaller platforms that failed to reach Phase 3 are currently bleeding cash. They lack the scale to squeeze their users, and they face extinction. To survive, these struggling rivals are forced to consolidate their assets. We are seeing massive mergers and acquisitions as legacy studios scramble to pool their content libraries together. This desperation has birthed the concept of the Super Bundle. Former fierce competitors are now teaming up to offer packaged content deals, mimicking the structure of a traditional TV network. This massive consolidation systematically eliminates market competition. When a dozen separate streaming options merge down to 3 or 4 tech conglomerates, pricing power is concentrated into the hands of a few executives. Contrast this expensive, ad-filled, bundled reality with the nostalgic past of traditional television. We spent a decade cheering for the technological disruption of legacy media, only to end up exactly where we started. We have rebundled the old cord under a new name at a significantly higher price. The era of cheap streaming was a fleeting illusion, and the bill has finally arrived.